If you're in your late 50s or early 60s and most of your money is sitting in pre-tax retirement vehicles like retirement annuities, pension funds, or company provident funds, then this masterclass is for you. Here's the uncomfortable truth. Many South African retirees end up paying more tax in retirement than they ever did while they were working. Not because they made bad decisions, but because most of their money sits in vehicles where every rand they withdraw is taxable.
And that's the part most people don't see coming. They've saved diligently, they've used the right vehicles, and yet the structure quietly works against them later.
Today we're going to explore three things: why this happens, what the real risks actually are, and how smart retirement tax planning can reduce it, often dramatically. Hi, and welcome back to the Family Wealth YouTube channel. If you're new to this channel, I'm Hadi Swart, certified financial planner and a director at Family Wealth Custodians. For the past decade and a half, we've helped South African families structure retirement income, reduce unnecessary taxes, and retire with confidence.
And Annie Kloppers, Senior Financial Planner at Family Wealth Custodians. In these masterclasses, our role is to ask the questions retirees are thinking and help translate planning theory into their real-life decisions.
Quick reminder before we start. This masterclass is for educational purposes only, and it doesn't constitute personal financial advice. Please always consult a qualified financial professional before making any major financial decisions.
This session was prompted by a question from one of our subscribers. Most of my money is in retirement funds. How should I think about tax once I stop working? And this is such a good question because most people only start worrying about tax after retirement, which is often too late to fix the structural problems. So instead of answering this theoretically, we're going to work through a real South African case study.
Meet John and Sally, a real planning scenario. Of course, the names are changed. John is 60, Sally 55, and they have no financial dependents or any children. Their balance sheet looks strong. Cash of approximately 1.5 million rand, retirement funds, which include retirement annuities and company preservation funds of about 22 million rand, and a small discretionary investment of approximately 1 million rand. No bond. This is the kind of couple that people would describe as well prepared, and they are from a savings perspective. But this is where most people stop thinking.
Right now, while they're still working, everything feels fine. Their tax rate feels reasonable, their income feels manageable, and they're doing the right thing by contributing towards retirement funds.
And those contributions come with big tax deductions. Up to 27.5% of your taxable income capped at 350,000 rand per year. So for years, SARS has effectively been giving them a tax relief up front.
Which creates the illusion that retirement funds are always tax efficient.
That's until retirement changes the rules.
So at retirement, John faces his first major decision: how much of his retirement fund to take as a lump sum and how much to convert into annuity. And this is where people often underestimate the impact.
Based on the 2026 retirement tax table, the first 550,000 rand of lifetime retirement lump sums is tax-free. Anything above this is taxed on a sliding scale.
So that tax-free portion is incredibly powerful, but only if it's used properly.
The common mistake I found is the following: taking it, spending it unnecessarily, and pushing more money into taxable income later. Used wisely, that tax-free cash can reduce future taxable drawdowns, create discretionary capital, and improve long-term flexibility.
Most retirees then move into a living annuity or sometimes a life annuity. And on paper, this feels like a safe phase.
Yes, because the early years often look like this. You retire, your income drops, your tax bill drops, everything feels under control.
Until something strange happens.
In South Africa, living annuities have a minimum drawdown of 2.5% and a maximum drawdown of 17.5%. As your portfolio grows, the rand value of those percentages grows too.
Which means that even if your lifestyle slows down, your taxable income can keep increasing. Eventually, retirees say, we don't need this much income.
And unfortunately, SARS doesn't care. Every rand withdrawn from living annuities or life annuities is taxed as normal income.
So without proactive planning, especially in the slow go and no-go phases of retirement, portfolios keep growing, drawdowns increasing, taxable income rises.
Suddenly, this retired couple is earning 1 to 2 million rand a year on paper, paying 40% in marginal tax rate, and paying tax on money they didn't even need to spend.
So that's not a lifestyle problem, it's a structural planning problem. This is a big mindset shift for many retirees. The real risk is often not running out of money.
The real risks actually are paying too much tax, losing flexibility, or being forced into income that you don't actually need.
So if John and Sally keep doing nothing, their living annuity income keeps rising, their tax rate keeps climbing, and the flexibility keeps shrinking.
They're forced to withdraw more, pay more tax, and reinvest after tax, which is incredibly inefficient. And the longer you wait, the fewer levers there are to pull.
So this is where proactive planning comes in. The goal is simple. Pay tax on your terms and not SARS's terms.
Before retirement, you have the most options, structuring money across retirement, discretionary, and tax-free accounts. Also using things like tax-free savings accounts properly, managing disallowed contributions, and using tax wrappers like endowments or sinking funds, creating income flexibility before drawdowns becomes punitive.
And if you're already retired, options are fewer, but not zero. Excess income can still go into a retirement annuity. Disallowed contributions can later reduce tax via Section 10C. Drawdown levels can often be managed more intelligently.
Good retirement planning is not about avoiding tax
It's about smoothing tax over time
and keeping income flexible.
and preserving control. So, Hardy, here's a final thought. John and Sally are going to be fine financially.
Their danger isn't poverty, it's just inefficiency. And one final reminder, tax planning in retirement doesn't start at retirement.
Unfortunately, SARS is very patient.
If you'd like to understand how much tax you might pay in retirement, whether your income is structured efficiently, and how to build retirement income plan that actually works in South Africa, that's exactly what we do at Family Wealth Custodians. You'll find a link in the description below to connect with us.
If this masterclass helped you, like the video, subscribe to our YouTube channel, and comment below. Do you know how much of your money is pre-tax?
Until next time, I'm Ardi Swart.
And I'm Ivo Klopper.
This is Family Wealth. Keep investing into your future.